Welcome to the Financial Freedom Secrets Show. This is your host, Jackson Milan, the Wealth Mentor, helping business owners create financial freedom faster by mastering the language of money. Want to see how well you're tracking towards financial freedom? Complete our 40-point financial performance scorecard at wealthhealthcheck.com.au. That's wealthhealthcheck.com.au. The average score for most business owners is 18 out of 40. So complete the scorecard now and see how well you're tracking towards financial freedom.
So Jackson, you say there's only 3 ways to build predictable wealth as a business owner. That's a bold statement. Can you break down the investment operating system? So the investment operating system is a framework that we developed to help business owners create sustainable and lasting wealth. And through studying thousands of hugely successful business owners, these are people who are on rich lists the world around. There are really only 3 ways that you're able to build lasting and sustainable wealth, and everything else is either a gimmick or it's a speculative investment that has ultimately no guarantees. Number 1 is your business. Our job as small business owners is to build a valuable business that can ultimately one day be sold. And for so many people that I speak to, they said, Jackson, I've got no intention to sell my business. But for the vast majority of business owners, you don't want to sell your business until one day you do. What ultimately happens is that you get the shits, you get jaded, you get burnt out, or worse, something happens outside of your control. Either you or a family member gets ill and you have a change in circumstances and you need to sell the business. And the unfortunate reality is the business is not ready for sale. You don't understand the drivers of profitability and business value. And because you need to fire sell that business, you are now in a position of having to either take a fraction of what you believe the business was worth, or being a harsh reality that your business is actually worth less and you're having to close it up without anything to show for it. Now, the first thing that we need to do as business owners is that our business needs to always be ready for sale. What does that require? Well, firstly, we need to understand what is the methodology of valuation for your industry, right? Every single business has a valuation methodology. The only reason why certain businesses don't get sold is because they're not ready for sale. So, for example, in a trade business, for many of our clients, they've been able to sell their business for 3 times their profitability. That requires a number of things. Understanding the valuation multiple and understanding how to normalize profit. Now, the next part is having profit. If your business doesn't make any profit, particularly after you've taken a market wage or salary, then your business is worthless. So let's say, for example, you've got $1 million business and it makes $100,000 a year in profit, but you don't take a salary. Well, it's safe to say that your salary should be $100,000 a year, which now means the business makes 0 after your salary, which now means that a 3 times multiple of 0 is 0, right? So we need to understand what is the profitability of the business, what's the multiple. And this allows us to work out what's your ideal exit price. So let's say, for argument's sake, that your goal was to exit the business for $1.5 million. And you knew that you could get a 3 times multiple. That means we need to build the business to $500,000 a year in profit. You might not be there now, but we can work out a plan to get you there. The next factor is key person risk. If somebody's looking to buy your business, they don't necessarily want to buy themselves a job, and they also want to have the peace of mind and certainty to know that once you sell the business isn't just going to tank the next day and all of the clients and staff are going to leave. So how do we resolve key person risk? Well, we need to implement systems and structure that remove you from the necessity of being in the business, right? This takes time, and it usually takes a business 1 to 3 years to properly set up the business to get the most value and to reduce that key person risk. And then the third aspect is the future opportunity for an acquirer. We've got to realize that the best acquirers are buying a business because of the future potential of that business, right? Like they're considering, well, can I just start this myself? Or is this business got such a head start on what I would have to create myself that it would be silly for me to not buy it? And this is the difference between a business being worthless and a business getting a significant financial multiplier. So that's the first pillar. We should always be building the business to be prepared for sale because you don't want to sell your business until one day you do. 2 is property. Property is one of the most valuable ways that you can grow and scale your wealth very, very quickly. And the reason for it is not necessarily because property has been the most high-performing asset ever. In fact, property versus Australian shares have returned about the same on average over the past 30 or 40 years. The fundamental difference between the two is the leverage. When we buy property, we have the ability to take a relatively small deposit, in some cases 10% of the value of the property. We can borrow the rest from the bank, and we can now control 100% of an asset that compounds and grows. So if we put some numbers around that, if you've got $100,000 in savings, you go and borrow $900,000 from the bank, you go and buy $1 million property, and that property goes up by 5%, that is now a 50% cash on cash return, because you put in 100 and it's grown by $50,000, right? This is the power of property. And we've seen our clients build significant wealth through a relatively small portfolio of 3 to 5 high quality investment properties. Now, not all properties are created equal. And there are 5 fundamental drivers for good quality property in Australia. And this all comes down to the dynamics of supply versus demand. So 1, we need net migration coming to an area. We need more people moving to a location than are moving away, because this is what creates demand. 2, we need diversified employment. We need a reason for people to want to move to an area, but we don't want that reason to be a single sector, like resources or oil and gas, right? We want to have a diversified employment market so we don't have volatility in these cyclical markets that happen around the country. Then 3, we need infrastructure spending. This is both public and private infrastructure. We want the government spending on roads and railways and hospitals and schools. This is what creates livability, right? And then we want private infrastructure like cafes and restaurants and entertainment, because this is what increases the quality of your lifestyle. 4, we want to understand future supply. We want to buy in areas where future supply is limited, meaning that there is strict zoning rules. So we don't buy in CBDs where there's relaxed zoning where they can build massive towers. And also, we don't want to buy on fringes of cities whereby the developers can build house and land packages as far as the eye can see. We want to buy in infill locations that are highly desirable, that are completely built out, that have very strict zoning, meaning that in order for somebody to build, they've got to buy something and knock it down. And if they do knock it down, they just can't build eyesores, okay? And then lastly is affordability. This is not what you can afford as an investor. This is what the typical people in the areas that you are looking to buy can afford, because property prices are defined by being more demand than there is supply, and then prices will go up until such a time as the local population can afford it and the banks will lend them money. So what we want to understand is what is the average income that's going to the rent, and what is the average income going to the average mortgage in that area. And that allows us to gauge affordability. So if we understand these 5 factors, we can buy in good quality, blue chip, desirable locations where we can get high quality tenants who are not going to punch holes in the wall. We can get properties that grow consistently over time, and in turn create additional passive income through dragging up the rental yields. This is how we invest in property. And then the third pillar is shares. And for so many people, they're frightened of shares because they've heard horror stories of people losing a lot of money. And when we invest in shares, there's basically 3 ways we can do it. 1, we can buy direct shares. So you can go and buy Telstra or BHP or CBA, or you can buy international shares like Apple or Microsoft. But you're either got to go and do the research and understand the fundamental drivers of what makes that a good company, because you're investing in a portion of somebody else's company, right? And the value of that is typically reflective of the quality of the company based on its financials and fundamentals, and then based on the market perception of what investors perceive that company to do in the future. You either need to do that research or you speculate and you stock pick by throwing darts at a dartboard. This is not how we should invest. The second way is through managed funds, where you hire a professional fund manager who goes and picks the stocks for you. And typically these fund managers are going to pick a portfolio of 30 to 50 companies, and their job is to try and outperform the market on average. They usually charge about 1 to 3% as a management fee. And the scary statistic is that 80% of active fund managers underperform the market after fees and taxes. The vast majority of them are not very good at it. Which also reaffirms that if you're not a professional investor and professional investors can't outperform the market, what chance have you got? Which then leads us to the third way, which is index investing, which basically is a way of investing in the entire market on average. So, for example, you may have heard of the ASX 300, which is the top 300 companies in Australia. We can go and buy an index fund that holds all of those 300 companies, proportionate to their size. So you'd have a big slither of CBA, which is the biggest company at the moment, and you'd have the smallest slither of the 300th company and all of the ones in between, and you would get the average of however those companies perform. Now, I personally invest in an index style approach. I use a Vanguard diversified index fund that in the one fund it has about 4,000 underlying investments. And that allows me to get the average of over 4,000 companies around the world, which on average has returned about 8 to 9% per annum. Very, very simple. I don't need to worry about stock picking, and I can just focus on my contribution. What I do is I set up an automated transfer. It's direct debit, happens once a month, and then every 90 days I have a reminder and I review it and I look to increase it. And my rules are I either increase it by $1 or as much as I can afford. And whatever I increase it by, it never goes backwards. So what we see for a lot of our clients is their contribution might start at $500 a month, and then it goes to $550, and then it goes to $750, then it goes to $1,000, then to $2,000. And then we just momentum create this snowball effect where we start investing considerable amounts of money into the portfolio over time. So what does scaling for passive income actually look like in practice? Give us some specific examples. So the unfortunate reality is that most business owners obsess over passive income too early. And in fact, it costs them a tremendous amount of opportunity. You might think that's pretty crazy, right? Like extra income can't be a bad thing. But in fact, it can. So when we design the investment operating system for our clients, we have a very distinct strategy of the accumulation phase, which focuses primarily on capital growth, and the income phase, which focuses on passive income production. Now, what is the difference? What we've got to understand is that income is taxed in the year that it is received. So for the typical business owner, they're running their business, they're not going to retire for 10 or 15 years. They're producing $300,000, $400,000, $500,000 a year in profit. They're distributing that out and living their lifestyle, which in many cases is above their needs. And they've got surplus that they're using to build wealth. Additional passive income is just going to get added onto their personal income tax, requiring them to pay at least 30% of that in tax, to only have 70% left, which is just getting reinvested anyway. Which means that we have 30% less money rolling over and compounding each and every single year. Well, what's the alternative? We focus on capital growth producing assets. We buy assets that compound because compounding is not taxed. Unrealized gains are not taxed until such a time as they are sold. And what that means is that the same return allows us to compound 100% of that growth each and every single year because we are not losing anything to tax. And we do that over a period of 10, 15, 20 years, and the difference can be millions of dollars in opportunity. So what we've got to understand is that there need to be two distinct phases. We want to work out, ultimately at some point we want passive income, but we need to define the date in which passive income starts becoming important. We firstly focus on capital growth, we build those compounding assets, we create those unrealized gains, and then as we get closer to when we want passive income, we start either crystallizing some of these gain assets, or you leverage debt against those compounding assets, and then we use debt to go and acquire those income producing assets because we don't pay tax on debt. So when should somebody consider acquisitions versus organic growth for wealth building? So I'm very bullish on business acquisitions. I personally believe that buying businesses can be one of the most lucrative ways for you to accelerate your wealth very, very quickly. And I've been able to create, on average, about a 70 to 80% compound annual growth rate in my own investment portfolio just because of business acquisitions. However, we've got to realize that business acquisitions is an active investment, unlike buying an index fund, which is completely passive. With an index fund, we can go and make a direct debit into a portfolio. We can hold a couple thousand investments in that portfolio, and we have absolutely no job, no responsibility on an ongoing basis other than to leave the portfolio to do its thing, okay? Whereas when you buy a business, there is work that's involved, right? Even if you're buying a really good business, you still need to oversee the business, you need to manage the operations. There is more risk associated with that than there is with an index fund. So it's about understanding your risk versus return characteristics for every investment that you go into. And how do we calculate this? We work out what is the risk-adjusted rate of return that each asset must produce for us in order for it to be a viable investment of our capital. So for example, shares, we want to have a benchmark rate of 8%, right? Because we know, okay, well, 8% is giving me enough of a rate above paying off my mortgage or putting money in cash that I'm being compensated for the comparison, right? So let's say the mortgage interest rate's 5%, I'm getting 8% in a portfolio, so I've got a 3% risk premium above and beyond my mortgage interest rate. Property. Property might only return a 5% on the asset, but the cash on cash return is significantly higher. So you might be getting 25 to 50% cash on cash return a year. And then in business, ideally we want to be producing between a 30 and 100% cash on cash return per annum, but it comes with extra responsibility. So vehicle number 2 is property investment. Explain your property portfolio plan and how it differs from typical real estate investing. So my philosophy for real estate is about acquiring the best quality real estate that you can afford in the most desirable blue chip locations, right? I'm a big believer that there is no such thing as a property market. Like, for example, Sydney has been the outperformer over the course of the last kind of 20 years, but Sydney is very, very expensive right now. And yes, I'm confident that Sydney will continue to do well over the next 30 years. However, the properties that you're buying now, the yields are very, very low. So therefore the cost of holding those properties is significantly higher. And that also means the risks of you having to sell that asset because of the financial pressure of holding it are much greater than other opportunities. So my philosophy is about finding blue chip markets that have the best fundamentals, that mean the cost of ownership are as low as possible, giving you the best opportunity to hold those properties for as long as possible. So for example, my last investment property that I acquired is in Geelong. It's an hour to the kind of northwest of Melbourne. And the reason why I bought that is because the Melbourne property market has sat flat for a very long time. The rental yield actually meant that the property was about positively or neutrally geared, and it had a consistent long track growth rate over time, but it is sat flat for a period of time, meaning that it has the right fundamentals for future growth. So I foresee that Geelong is a blue chip market that's going to continue to perform well. So it's about having the data that allows you to make informed and educated decisions and buy the best quality property that you can afford. Now, that property that I acquired was about $750,000. There are other properties that other property advisors talk about that are $300,000, $400,000, but I believe that compounding works best on bigger numbers, right? So if you've got $1 million that grows at 10%, it's going to make you 100 grand. Whereas if you've got 500,000 that grows at 10%, it's going to make you 50 grand. So the aim of the game is to control as much asset base as you possibly can. So our goal for our clients is how do we accumulate 5 good quality blue chip investment properties, and ideally build that so it has a net wealth of about 5 million, and then that builds the core of our portfolio. So you emphasize cash flow positive from day one. How is this achievable when most property investors accept negative gearing? Now, I'm going to preface this by saying that there is nothing wrong with negative gearing, okay? Residential real estate in Australia is actually not a cash flow game, unlike the US market and other markets around the world. Whereas when we're buying residential real estate in Australia, we're doing it for the capital growth. The goal is about making sure that the portfolio is able to wash its own face, meaning that the cost of ownership is insignificant, or that it's covering itself at the first possible opportunity, meaning that you can continue to hold the property portfolio without any pressure financially. Because what we find is that for the vast majority of people, they only hold a property for 5 years or less, and the reason for it is because they can't stomach the cash flow. And this is a big issue. This is where we see properties in Sydney and other markets, Brisbane now, are now significantly negatively geared, and it means that for many investors, they're out of pocket $300, $400, $500 a week per property. And that adds up pretty significantly, particularly if you go through some financial hardship or have some curveballs that are thrown at you. So my philosophy is positive cash flow is always better than negative cash flow. If we're going to buy property, we want to understand the fundamentals to get as close to positive cash flow in the first instance as possible. For example, my last property that I acquired is pretty close to cash flow neutral. As we sit right now, I think it's probably costing me about $100 per week out of pocket. And then we want to make sure that we've got the fundamentals that over the course of the next 3 to 5 years, as a result of the growth, that drags up rental yields, and then that allows us to get it to be positively geared in the next 3 to 5 years. That serves a number of purposes. 1, removes the cost of ownership. You don't have to contribute anything to top it up. 2, it frees up borrowing capacity, so then we can go and buy more properties. And 3, it also frees up bandwidth, because so many clients we speak to, they have this investment property and they're like, oh shit, I've had this dog for 10 years and it's been costing me money hand over fist, and they get the shits with it. And that has a negative impact on the way that they view their wealth building. So that's really important. Now, break down commercial versus residential property investment for business owners. Now, there's a time and a place for commercial. And I personally believe that commercial happens after you've built your core foundational residential real estate portfolio. So that's usually that we've got to get 5 good quality residential assets. And if we're assuming that we're buying those assets around about that 750 grand, we want to build like $3 million or thereabouts as a residential portfolio. Now, commercial comes into play after that for a couple of reasons. One, commercial is much better for yield. A good commercial will be getting you about an 8% yield, 6 to 8% net. If we buy good commercial, it also should give us capital growth. But the downside of commercial is that it is riskier on the basis that it tends to have higher vacancy. Now, if we do buy well, we can mitigate that, because if we're in a highly desirable commercial location, commercial properties are highly sought after. And we can also mitigate that by getting long-term leases with good quality tenants. But the other factor is we want to wait, because good quality commercial is usually at a much higher price point. Like for many of our clients who are buying quality commercial, they're spending $1.5, $3 million minimum to buy a good quality commercial asset. Like sure, you can buy small warehouses and industrial units and things like that for much cheaper, but it's not at that caliber that we want to be at that stage of the journey. So commercial's fantastic once you've built that residential base. So vehicle number 3 is share market investment. How does a business owner create an investment philosophy that aligns with their goals? Now, I think the share market is probably the most emotion-evoking investment that I've ever come across in my years of advising. And the reason for it is because most people have heard some sort of horror story of people losing their money in the share market, okay? And I want to debunk this for a moment. How do you lose money in the share market? There's fundamentally 2 ways. One, you invest in a company that goes bust, that goes broke, that goes into bankruptcy. And in that situation, it basically means that the business essentially falls to zero, creditors sell off all of the assets, it gets liquidated, and shareholders might get returned 10, 20, 30 cents on the dollar that once invested, if they're lucky, right? And the second way is that the market falls and people get emotional and they sell the shares at a loss. And this is what happens most often. It is actually not that common for businesses to go bankrupt, particularly in the way that we advise our clients to invest in the share market, where we don't advise our clients to buy direct stocks. We get them to invest in managed funds and index funds that have widely diversified portfolios of hundreds, if not thousands, of companies. So the bigger risk is your emotion. What we see is, like, for example, in the GFC, share markets fell 40%. And so many people, particularly retirees, got scared, converted all their money to cash, and crystallized their losses. So the analogy I like to use here is, like, imagine that tonight, after watching this video, somebody come and knocked on the door of your house. And let's assume that your house is worth $1 million today. And they come with a briefcase with $600,000 in it. Under what circumstances would you take that briefcase? Never, right? Why? Because you know your house is worth $1 million, right? So this is the same with the share market. On any particular day that the market falls, it is somebody coming and knocking on the door with a briefcase, offering you a price. You are under no obligation to sell it. It is just an offer on the market. And only if you take the briefcase do you crystallize the loss and accept that as the true value of that asset. So if you choose to do nothing, then you wait for the market to return. Now let's flip this on its head. Let's imagine that your next door neighbor has a similar house to yours that's worth $1 million, and you heard through the grapevine that they were prepared to sell it for $600,000. What would you do? Would you buy it? Well, of course you would, because you know it's worth $1 million. And this is the exact same with the share market. So when the market falls, it creates a buying opportunity, because you have the opportunity to buy an asset that was worth significantly more for a discount. This is like going at shopping at Boxing Day sales, okay? And this is just about changing the psychology of your investments, of going from a psychology of fear, of people taking from you because you have a lack of understanding, to going to a position of abundance, of when you do understand how the market works, of using those market cycles to your advantage. Now, I'm not Nostradamus, even though I might look like him. I don't know what the market's going to do, but what I know is that the market will go through cycles. On average, 1 out of every 4 years is a negative year, okay? What does that mean with the other 3 years? It means every 3 out of every 4 years is a positive year. So the strategy that we do with share market investing is that we drip feed money into the market every month. Because some months shares are going to be worth $1. Some months they're going to be worth $1.20. Some months they're going to be worth 70 cents. But what that allows us to do is to average our price over time, and we don't worry about market timing. It's about time in the market that matters. And we build enough resilience and confidence that when the market does fall and there are flash crashes, that you are so excited by that scenario that you are piling in because you've got confidence about the market. This is the scenario we want to be in. Now, walk me through your approach to diversification and risk management across asset classes. So, the three fundamental that we spoke about is the business, property, and shares, but we go further than that. We want to build a strategy that not only diversifies into shares, because there's Australian shares, there's international shares, there's listed real estate, there's infrastructure, there's bonds, there's fixed interest, there's cash, there's also alternative assets and private equity. And every person is different and their risk profile is different. So when we work with building an investment operating system for our clients, we firstly go through an education process. We do a deep dive into all of these various asset classes and their pros and cons. We then help you understand your philosophy. What are you trying to achieve? What's your tolerance to risk? What are the things that you're really bullish on? What are the things that you're really bearish on? And then we work on constructing an investment philosophy that you understand, that you know, that you trust, and that you understand what the historical performance has been and what are the characteristics and attributes of that portfolio so you can have fair expectations over time. And it's through understanding this that you're able to make informed and educated investment decisions and actually get excited about it because it's pretty fun. Now, how do you structure investments for maximum after-tax returns? So this is really important. And we will look at structuring our portfolio into three distinct tax buckets. So tax bucket number one is personal name. And to be fair, we try and structure as little wealth in your personal name as possible. The reality really is it's about liquid cash that you have available, usually in an offset account that we use as a war chest. And for most of our clients, it's about 3 to 6 months of their monthly living expenses. So if your living expenses are 10 grand a month, we want to have 30 to 60 grand in savings. For most of our clients, that number is about 100 to 150, okay? Then the second bucket is in tax structure. So we want to use bucket companies and we want to use discretionary trusts to hold the vast majority of your wealth that you're going to utilize between now and age 60. Now, the significance of 60 is the earliest age that you can get access to your superannuation, okay? So we want to build enough wealth in bucket companies and trusts that allow you to be financially free before 60, okay? That's property, that's businesses, that's shares, those types of investments. And then our long-term bucket is super. Now, you may have heard horrible things about super, but our superannuation system is the best retirement planning system that exists in the developed world. We have the most lucrative tax rules that exist in any country. There is no other country that has the ability to contribute to your superannuation and pay 15% tax. Inside super during your accumulation phase, any earnings are taxed at 10 to 15%. Once you get to 60, you can convert that into pension phase that pays 0% earnings tax, and any income you draw from that pension pays 0% income tax. Better yet, if you sell your business for less than $2 million, or you have less than $6 million in net assets and you can sell your business for up to $6 million, not only can you sell that business tax-free, but you can also get the vast majority of that money into superannuation as well. This is a super lucrative tax system. So our job when we work with our clients is to help them structure their wealth in that short, medium and long-term bucket to make sure that they've got enough for each of those phases of their life. So how does somebody combine the three vehicles for maximum wealth acceleration without overcomplicating their life? Now, this comes back to our ethos of the wealth mastery machine and spending no more than 30 minutes a month managing your money, right? Like, let's face it, I get excited about money and wealth because this is what I do every day. For the vast majority of people, wealth is a means to an end. They want to be able to live an amazing lifestyle. So the key here is about setting up systems, okay? We set up the systems, we implement the structures, we create the automations, and this is what allows you to manage your money in 30 minutes a month or less. So what this requires you to do is to take action, right? And the first action that you can take is to complete the financial performance scorecard. So if you go to wealthhealthcheck.com.au, complete the scorecard and it'll help you identify the areas that you're not focused on right now and what's the lowest hanging fruit. It'll help you work out exactly where you need to be focusing your time and attention, and it'll give you a really clear action plan of how you charge forwards and make the most of your money. That's the best place to start.